Welcome all to Corporate Issuers Learning Module 6 on capital structure. Before we get into the LOSs, here is a simplistic balance sheet, which is very familiar to people who've been through Learning Module 4 and 5 already. On the right-hand side, we've taken a very simple balance sheet. We have grouped together current assets and current liabilities into working capital, and all of our long-term debt and equity into invested capital. In Learning Module 4, we talked all about working capital and how much of our invested capital was tied up in there. In Learning Module 5, we talked about how much invested capital went into long-lived assets and the returns we were getting from those long-lived assets. Well, in Learning Module 6, we're going backwards. We're saying, let's take our invested capital of 6,500 and let's talk about how we got there. Let's talk about the decision that led us to funding our business with 2,500 of long-term debt and 4,000 of equity. Why not more equity? Why not more debt? They're the questions we're going to attempt to answer in here. And our first step will be to hit the first LOS, which says calculate and interpret the weighted average cost of capital for a company. Let's get to it. Here we go. The issuer, remember, is the firm, the company issuing the debt. Their required rate of return is their cost of capital. It's derived from its investors' required rates of return, the people who are providing the debt and providing the equity. Those investors will look at the risk of the company and decide, given the risk of the company, the return they require for giving you their capital. Now, the WACC, the cost of capital weighted between all the different sources, the WACC will be applicable to the company as a whole, but there may be individual projects that the company will finance with different weightings, or there may be individual projects will have different risks. And if they have different risks, they will have a different required return. But that's not what we're going to talk about right now. Right now, we're just looking at an overall WACC. How do we get there? Well, we derive our returns required on debt and required on equity from those providers. We then take that capital, and as we talked about in the last learning module, we invest it in capital projects, capital investments that will give us positive NPVs. Once we've exhausted all of our positive NPV projects and we have capital left, that should be returned to our providers of capital. Why? Because they can get their required return elsewhere. Remember, their required return is their opportunity cost. The best alternative foregone. They have decided what they require from you by looking at what they could get elsewhere for similarly risky investments. So if you can't get any positive NPV projects, give it back and they'll get that return elsewhere. Our main sources, as we just said, debt and equity. Debt for investors is less risky. Make sure you understand which perspective we're looking at there. Investors, it's less risky for because they have a priority claim. They will get paid back before equity providers. It may be secured. Debt may be secured with underlying assets. Therefore, for the issuer, it is a lower required rate of return. If it's less risky for investors, they will demand a lower return. Equity, on the other hand, is more risky. It is a residual claim. Debt holders will be paid back first. Equity holders will get paid what's left after meeting liabilities. In most cases, that's not much at all. Because it is more risky for investors, they will demand a higher return. The cost of equity, therefore, is greater than the cost of debt for issuers. RE is typically how we'll denote the cost of equity, and RD, the cost of debt. The weighted average cost of capital is the weighted average of those two sources of finance, assuming they are the only two sources you have. There may be others. So the formula will look like this. The WACC is the cost of debt times its weighting plus the cost of equity times its weighting. How do we get to the cost of debt? Good start is the interest rate on existing debt. However, think about what we're using this WACC for. Throw your mind back to the prior module. If you haven't looked at it, what we were doing was assessing the NPV of capital investments using the cost of capital, using the WACC. So we should be forward looking. We're using this to look forward and assess projects, while the interest rate on existing debt, you could argue, is backward looking. So maybe you might consider using the cost of recent borrowing for comparable companies being those with the same sort of credit risk. Secondly, if interest is tax deductible, the cost of debt is reduced. It will be RD into 1 minus T. Why? Very simple example. If you pay out, let's say, interest of 10, let's say your debt is 100 and it's 10%, so you're paying interest of 10. If that reduces your taxable income by 10 because it's deductible, it will save you tax. It will save you tax at, well, let's say, e.g., the tax rate is 30%. It will save tax at 30% on those $10, $3. You pay out 10, but you save 3 in tax. The net payment is 7. Quickest way to get to that 7 would be the 10% into 1 minus 0.3. The 1 is showing you the entire interest you pay out. The 0.3 is showing you the 30% that you save. So fairly obvious, hopefully, but just in case it wasn't, that's why when interest is tax deductible, we 1 minus T the cost, which brings the cost of debt down even further. Cost of equity on the right-hand side, equity investors' required rate of return. Not quite as easy as debt. We can't just turn around and say, okay, well, let's look at the existing interest rate. There is no historical interest rate to observe for equity. What you can observe historically are returns on equity in general. So look at the long-term average of a market, a broad market index. Not ideal, but it's a starting point. Now, later on in the curriculum, when we get into the world of equity and the world of fixed income, there'll be a whole world of learning outcome statements in which we'll calculate the cost of debt and the cost of equity in a lot more detail. Here, it's really just a high-level overview. What we're interested in is the decision on the mix rather than the actual costs. And final point on equity, interest in most jurisdictions on debt is tax deductible. Distributions on equity, i.e. dividends, are not tax deductible. So you will not get any 1 minus T-ing of the cost of equity. They're the costs. What about the weightings? Weighting here and the weighting here. They could be based on either 1, market values. Does that make sense? Well, it does to me, because we said the issuer's required return, so the issuer's WACC, is derived from your investor's required returns. That's the opportunity cost of capital for your investors, which in turn is based on market values. So the weightings, to be consistent there, should be on market values. However, you may choose to use target values. Target values are those that have been picked by management. MGMT there just means management. They've picked a target. The argument could be in the long run, and you may be assessing a capital project in the long run for 5, 10, 15, 20 years. In the long run, that capital structure, that target capital structure should be the one on average that they hit. So you could argue that it's more relevant. However, targets, as we'll talk about later, are typically based on book values, not market. So that is an issue. And as we mentioned up front, other sources of finance should be included. We've got a simple version of the WACC here where we only have debt and equity. If you have other sources of finance, maybe preferred stock, maybe non-controlling interests. That's the amount of a group owned by your minority shareholders, your non-controlling shareholders. You should include those. In the examples we'll go through and the examples throughout the module, we'll only have debt and equity to worry about. And let's look at one of those examples right now. We have a corporation financed with 40 million in debt, 60 million in equity. That gives me 100 million in total. Stunning math there. Interest is tax deductible. That tells me we're going to see a 1 minus T somewhere. New funds will be raised using current capital structure. So we're going to raise it in these proportions, which looks like 40% debt, 60% equity. Debt investors' required rate of return pre-tax, note that, is 4%. That 4% will need 1 minus T-ing. Equity investors' required return is 10%. No 1 minus T-ing there. Distributions not deductible. And T itself, the marginal tax rate, is 23%. Here's our WACC. The cost of debt pre-tax, which is our 4%. Into 1 minus T because interest is tax deductible, 1 minus 0.23. Multiplied by its weighting, 100 million in total, 40% was debt, 60 was equity, so 0.4 for debt, plus 10%, our cost of equity, times 0.6, its weighting. Put that through your calculator, you'll get 7.23%. Quick note on units. I used 4% here, so I put into my calculator 4, and 10% here, so I put in 10, and the answer my calculator gave me was 7.23. You could, if you had chosen, put in 0.04 and 0.1, put these percentages in as decimals, and you would have got 0.0723, which you could have then turned back into a percentage. Either is acceptable. Fairly straightforward calculation, you have to say. As always in the world of CFA, think of the analysis. This is pretty straightforward, so try and think what's exciting about it. Well, what's exciting about it is to start changing the inputs. Always think when you see a formula, what happens to the output, in this case the WACC, if I change the inputs, the cost of debt and the cost of equity. Fairly obviously, if either increases, the WACC increases. The weightings. You would expect, as we said earlier, for the cost of debt to be lower than the cost of equity, and it is. So if the weighting of debt increases, that's going to drag the WACC down, in this case, towards 4. If the weighting of equity increases, it will drag it up towards 10. And finally, the tax rate. What does an increase in the tax rate do? An increase in the tax rate brings down the post-tax cost of debt. You save more tax. Cost of debt comes down, and the WACC will come down. So whenever you see examples like this, try and think around them and have some fun with them. Always be thinking, change the inputs, what happens to the output? And in that spirit, let's have a look at another one. We have an issuer's balance sheet here with $400,000 of bonds. Common stock, 40,000 shares. That's the number of shares to give 600,000. This is in dollars. That gives total liabilities and equity of 1 million. So again, that's a fairly simple 40%, 60%. Current stock price is $20 per share. Required return on debt pre-tax is 5%. Required return on equity is 10. This is looking awfully familiar. Marginal tax rate this time is 20%. I'm assuming, being as we've been given a tax rate, that tax is, or rather interest is deductible. What are the weightings? Well, as we've already said, 40, 60 and 1 million on book value. It's 40% and 60% of that 100%. However, that's from the balance sheet. We took this from the balance sheet. And we said a couple of pages ago that typically we would take these weightings based on market value. And the current stock price is $20 per share. We were told we had 40,000 shares. 40,000 shares at $20 a share, that would give us equity of 800,000. We have no information on the market value of debt. So I'm just going to assume that the market value is the same as book, change the equity value out of my 100% now, which is 1.2 million. Debt is only 400,000 out of 1.2 this time, 33%. And equity is 800 out of that 1.2, 67. So the book values, the market values do not give you the same weightings. And makes an interesting point. If we start to use market values, we are exposed to a change in that market value. You can calculate the WACC for this company today using 33% and 67%. But if you wake up tomorrow morning and the stock price is now $25, everything changes again. Now at $25, my equity 40,000 times 25 is 1 million. Still no information on debt. I'll leave that at 400,000. But my total now is 1,400. What are my weightings? If 1.4 million is 100%, 29% is debt, 71% is equity. And I know that's heavily rounded, but these are just estimates, so I'm fine with that. What's the WACC then? Just as a bit of practice for WACC calculations. My cost of debt. Where was my cost of debt? Required return on debt pre-tax was 5%. So 5%. That was pre-tax. Tax rate is 20%. Multiplied by its weighting, 29%. Plus cost of equity, 10%. Its weighting, 0.71. That will give me 8.26%. That's my WACC at 25. It would not have been the WACC at 20. So if you choose market weightings, be aware, changes in market prices will change your calculated WACC. Let's move on. And we're moving on initially by flashing backwards to Learning Module 5. Remember what we said there. Positive NPV projects create value. And you'll get a positive NPV project if the return that capital investment generates is greater than the required return. Clearly, hopefully clearly from the earlier modules, management's aim, management's objective, if their interests are aligned with shareholders, is to maximize shareholder value, maximize shareholder wealth. They can do that by maximizing NPV. And given this equation, there are two ways of maximizing your NPV. You maximize the return. You sensibly choose your capital investments. You have a rigorous capital allocation system. All that good stuff we talked about in Learning Module 5. And you minimize the required return. You minimize your WACC. That's what we're looking at here. Now, it's not easy. Why is it not easy? Well, partly because the required return is derived from your investors, from their opportunity costs. And their return is dictated by market conditions. So it's not all within your hands. But your objective is to maximize that value, minimize the WACC somehow. Secondly, to match the liquidity and the time horizon with that of capital investments. So get a financing mix that matches the time horizon of your project. If you've got a 10-year project, you might want to match the finance that you're using to that 10-year horizon. Now, that's going to come up later on when we look at Modigliani and Miller. If you're trying to match it, and let's go even shorter, let's say you've got a 3-year capital investment. And I say to you, let's try and match the finance's life, the term of the finance, to that 3-year capital investment. How are you going to do that? Well, probably not with equity, probably with debt. In that sense, you are dictating the type of capital you raise based on the type of asset you're investing in. So hold that thought for later. Another quick example, just to keep us on our toes. An example here with 30% debt, 70% equity, interest being tax deductible. Cost of debt 6 and cost of equity this time 12. What happens if tax rates rise from 20 to 25%? This is just trying to emphasize the idea that minimizing the WACC is not easy, because you could do everything within your power to try and get the optimal capital mix to minimize your WACC, and then boom, government changes the tax rate, your WACC changes. Well, blast through the calculation. Cost of debt is 6. Tax rate is, I've lost the tax rate. Well, initially, there it was 20%. So initially it was 20%. Weightings, 30% debt, so times 0.3. Cost of equity, 12. Weighting is 70%. Initially, 9.84% was our WACC. After the change, tax rate is now 25%. There's your difference. And we mentioned this earlier. We have an increase in the tax rate here. It will reduce your after-tax cost of debt. It has therefore reduced your WACC down to 9.75%, a decrease in the WACC of 0.09%. Your WACC has moved due to outside factors. Next up, explain factors affecting capital structure and the weighted average cost of capital. We've defined the WACC, we've calculated it in that first LOS. Now let's talk about the factors that impact it. And we'll break it down really into two areas. Factors that affect the amount and the type of financing you require, and factors that affect the cost of debt and cost of equity. The amount and type of financing depends on the business model and the stage you're at in your life cycle. The costs of debt and equity, as we said, outside influences, the financial markets, top-down factors, some macroeconomic variables, and some issuer-specific factors. Let's start off though with the amount and type by looking at your business model and defining the business model, first of all, as capital intensive. The clue is in the name. These are businesses that require high levels of capital. For example, utilities, transportation, real estate, and so on. How do you spot a business that is capital intensive? Go to your financial statements, do some ratio analysis. You would expect to see a low asset turnover. What's asset turnover? Revenue divided by assets. Capital intensive, you're going to have high assets. A high denominator means a low ratio. High capex to sales, that makes sense. If it's capital intensive, you're spending a lot on your PPE. And high working capital to sales. So high working capital, high long-term capital, high capex. Now, if you are a capital intensive business and it's costing you too much, you feel it's costing you too much to raise this capital, you can try and change your business model. You can reduce your capital needs by franchising or contracting. For example, Hilton Hotels. If you stay in a Hilton hotel these days, it is highly likely that you are not staying in a hotel that Hilton Group actually owns. They have now franchised out or run the rooms in those hotels on a contract basis. So you can bring down the capital or remove the capital intensive part of your business by franchising or contracting. You could also, rather than purchasing assets with debt or equity, you can lease assets. Leases are often a cheaper way of getting assets than buying them with finance. Why? Well, you have a leased asset right there as part of the contract. It acts as collateral. These big leasing companies, first of all, have pretty good access to cheap capital, so they can offer these leases cheaply, and the asset is acting as collateral. What about a regulated industry? Banks, for example, utilities can be regulated. Then your capital structure may be dictated by the government or the regulator. Banks is probably the most relevant example here. Capital requirements specify a minimum percentage of equity. We've talked already about the relative costs of debt and equity. Specifying a minimum percentage of equity will probably increase your WACC. Why? Equity costs more. And finally, in business models, the opposite of capital intensive, capital light, very low capital needs. Again, identify this by looking at your financial statements. A very high fixed asset turnover, lots of revenue earned with a very small asset base and low capex to sales ratios. Service companies, technology companies don't need big, heavy assets. It may be they simply operate networks for others. Uber, for example, Airbnb. They don't have assets. And as an added bonus, they may well operate a business model where they get upfront payments or commissions, meaning their cash comes in before they've paid out for their suppliers, or to their suppliers rather, meaning they have a negative cash conversion cycle. Remember that from Learning Module 4. That means there's no need to raise finance to finance working capital. In fact, if it's negative, they are generating cash and they can use that elsewhere. Typically in these companies, employee compensation is stock-based, employee stock option schemes. Again, reducing the need for cash and hence reducing the need for finance. And if these types of companies are profitable from an early stage, they might have a minimal need for external financing until they really want to scale up. Secondly, dictating the amount and type of finance, the stage in the life cycle of the company. And I've just brought the diagram out from the curriculum because they can draw it much neater than I could. We have 3 phases: startup, growth, and mature. On the left, the startup phase. We can see we've got 2 lines here, revenues and cash flows. In the startup phase, we have, for most of it, 0 revenue. 0 revenue, but costs means negative free cash flow. Implications of negative free cash flow: no debt. Debt availability is little or none. Nobody is going to lend to you if you don't have any cash flows to pay them back. So typically what you're going to arrive, or the conclusion you're going to arrive at, is that I need equity. The second problem, you are probably too small and do not meet the listing requirements to go and raise equity from an IPO. So that equity is probably going to come from the founders, from the employees, from family and friends. If you look for debt, maybe you'll find somebody who gives you convertible debt. That's about as good as it will get. Convertible debt will turn to equity at some point and will cost you via dilution. Once you get to the growth phase, look what happens. Cash flow will start to rise, and hopefully at some stage in the growth phase will turn positive as your revenue is rising. So we've got revenue, we've got free cash flows rising, initially negative, but then positive. Once they turn positive, you probably will be able to get hold of some debt, but it will need to be secured. You are still a pretty high risk at this stage. Now, towards the end of your growth period, clearly you can't say these are absolutely definitive cutoffs. Towards the end of your growth phase, it will become more available. Well, certainly towards the start, it will need to be secured with your assets. And once you hit maturity, positive, and look at this, it's pretty flat, stable cash flows, you will have high debt availability. And because you're lower risk, you'll be able to get it unsecured. And you'll bring more and more debt into your structure. Benefit of that, debt is a cheaper source than equity. Increasing leverage increases return on equity, so it is desirable. They're the factors that affect the amount and the type of debt you need. What about those that affect the cost of debt and equity? Much more on this in the fixed income and equity readings, but for the minute, high level overview. Remember, as we've said, the cost of debt tends to be lower than the cost of equity because less risky from an investor's point of view, but they are influenced by the same risk factors. They move together because they are claims, after all, on the same set of cash flows. They're just being split between debt holders and equity holders. How do we get the debt investors' required return? They will demand, at least as a bare minimum, the risk-free rate. We'll usually calculate that as the return they could get on sovereign government debt, assuming that government debt is risk-free, plus a spread to compensate for the issuer-specific risk. Now, when we talk top-down factors, we're talking macroeconomic, country-specific factors that can both increase the risk-free rate and the spread. Things like the real growth rate. So what's happening to GDP growth in that country? Inflation, monetary policy, exchange rates, and so on. Now, some of these should be fairly obvious. If monetary policy, for example, is restrictive, then you would expect interest rates to rise. That's going to take this risk-free rate up before you consider the impact on the spread. Inflation rates, when they go up, they increase interest rates. If GDP growth is miserable, if you have an increased risk of recession, that tends to increase the spreads. So you have factors here that are boosting the risk-free rate, and if you're heading towards recession, an increase in the spreads as well. That's going to increase your cost of debt. The impact on cyclical sectors, things like mining, industrials, is going to be larger than it is on defensive. It's also, if you have a recession risk, likely to lead to lower stock prices. Lower stock prices increases your cost of equity. The stock price is lower, you get less cash in, it costs you more. And industry factors could also be significant. Fairly obvious one, oil prices. If oil prices are rising, think of the impact on oil producers and on airlines. Oil producers, it's obviously good news. Airlines, not so much, because oil is a key driver of their fuel cost. So they're your top-down factors. Issuer specific focus on, obviously, issuer risks. Start at the top of the income statement with sales risks. Stable, predictable, growing revenues lead to lower risk and hence a lower cost of financing. Fairly obvious. Think of that life cycle. If you are in the mature phase, we said in the mature phase, your revenues and your cash flows were just doing this, nice and stable and growing. If you have a larger customer base, you have a lower sales risk. Why? The risk is spread across your customers. It's not like if you lose one customer, your sales are halved. Each individual customer is fairly irrelevant. If it's subscription-based, that lowers your risk. Telecoms, for example, think of that versus construction. If we have a downturn, construction is in the toilet. But if it's telecoms, you're paying a monthly subscription, they get the same income. Profitability risks. We're talking there stability of profit margins. Now that is affected by the company's mix of fixed and variable costs. The mix of fixed and variable costs we can refer to as operating leverage. Operating leverage works like this. The higher your proportion of fixed costs, the higher your operating leverage. Higher proportion of fixed costs, higher operating leverage. That leads to higher risk. Why? Well, it's always, I think, easier when you're considering risk to think of the downsides. Imagine sales fall. You suffer a decrease in sales. You suffer a decrease in sales, your fixed costs don't move. Variable costs would, they decrease with sales. But your fixed costs don't move, which means you get a bigger drop in profits. The upside is, well, if sales go up, your fixed costs are still fixed, so you get a bigger increase in profits. But the larger your percentage of fixed, the higher your risk. Let's demonstrate. We have here two firms, both all equity finance, so we're going to ignore any issues with debt. All of them have got 100 total equity. All of them, both of them. And they are called Firm FC Plus and Firm FC Minus. And you can see the point of the naming system. Both have revenue of 100, but 50% of that revenue goes on fixed costs for FC Plus, only 20% for FC Minus. Variable costs for FC Plus are only 20. Variable costs for FC Minus are 50. That means both of them make a profit of 30. So the point this illustration is making, you can't just look at the profit and the revenue and say, okay, these two businesses are the same. No, because they have different mixes of fixed and variable costs. They have different operating leverage. And what we said on the previous page, the higher the percentage of fixed, the higher operating leverage, the higher your risk. Let's see if we can prove that. In this base case scenario, for FC Plus, we had ROE of 30%, profit of 30, 100 equity, and a net margin of 30 because, for simplicity, we've set revenue and equity to be equal. And the same for FC Minus. But let's see what happens when we get a 25% change in sales, a drop and an increase of 25%. Well, follow through the calcs. Revenue drops to 75 or goes up to 125. Fixed costs, and this should not come as a shock given the name, do not move. For FC Plus, they stay at 50. For FC Minus, they stay at 20. Variable costs move. They are a percentage of revenue. 20% of 75 is 15. 20% of 125 is 25. That gives us profit of 10 when sales drop and 50 when they rise for the firm FC Plus, giving us ROE in the downside of 10 over 100, 10%, and 50 over 100, 50% in the upside. Net profit margin, 10 divided by 75, 13.3 in the downside, 50 over 125, 40 on the upside. For FC minus, we got down to a profit of 17.5 and 42.5. That gave ROEs of 18 and 43, net margins of 23.3 and 34. Does that back up what we were saying? What we claimed was that firms with higher operating leverage, well, FC Plus has higher operating leverage. Why? Out of its total costs of 70, they both have total costs of 70, a higher proportion was fixed. That means higher risk. Is that borne out? Yes. Look at the range of ROE and net margins. Much bigger range for FC Plus. They are riskier. That's operating leverage. What about financial leverage? We can look at financial leverage and interest coverage and quite simply conclude that higher levels of debt, meaning higher financial leverage, give you higher risk. Why? Well, it limits your capacity to service more debt, so people are less willing to lend to you, and it increases the risk of cash flows for equity holders. You now have another cash flow that you have to pay out before equity holders get a return. That introduces volatility to returns to equity holders, increases risk. How do we measure this financial leverage? Well, you can look at debt levels versus profit or equity. How much debt do we have compared to profit, compared to equity? Debt to equity, your classic leverage ratios we looked at, or we will look at in financial reporting, financial statement analysis, or interest coverage, which they give you here as profit before interest and taxes. Okay, kind of makes sense. You look at the profit before you've paid out interest, divided by interest expense. Now, just be a little bit careful here. Interest expense. If you've studied FSA already, you might be saying, hang on, we were told in FSA that due to accounting standards, not all of the interest that you're paying goes through the income statement. So wouldn't it be more prudent, more conservative to measure interest coverage using interest paid instead of interest expense? My answer to that would be yes. But right here in this module, they just tell you interest expense. They're not going to make you get exam questions wrong by changing up definitions on you, so they'll make it very clear. Probably going to be clearest by the fact that all you have is interest expense. They don't give you anything else to use. You'd have to use it. Again, let's illustrate with an example. This time, we have two companies with assets of 100, revenue of 100, operating expenses of 70, but firm A, on the left, is financed with 80 equity and 20 debt. Interest they're paying is 2. Firm B, on the right, 40 equity, 60 debt. Interest they're paying is 9. So look at firm B. It has more debt, higher interest. That has higher financial leverage. I would expect B to have higher risk. Let's have a look by calculating profit, interest coverage, and ROE for the base case, and then for changes of 25%. This time we're changing 25% up and down on operating expenses. So we're going to go straight to operating expenses when we make these changes. In the base case, revenue 100, operating 70, operating income is 30. Interest expense is 2 for firm A. Profit is 28. What's their interest coverage? Well, given the only figure I have to use is interest expense, that's what I'll use. Interest coverage in this first case is going to be 2 divided by, no, it's not, is it? It's going to be, what have I got to pay that interest? Operating income of 30 divided by 2, 15. Return on equity, my profit was 28. My equity is 80. So 28 over 80, 35%. Again, we're just rounding. Now for firm B, I have 100 in revenue, 70 in operating expenses, operating income identical at 30. Their interest expense is 9 to give profit of 21. What's their interest coverage? Operating income of 30 is the same, but 9 is the interest they must pay out. Interest coverage of only 3.3. I think we can kind of fairly clearly see our conclusions already here without going much further. 15 versus 3.3. But let's do the changes. We have an increase, first of all, of 25% in our operating income, so 37.5. Interest expense of 2, 35.5 is our profit. What's our interest coverage? Now it's 37.5 over 2, 19. Our return on equity, 35.5 divided by 80, 44%. And finally, if operating income is only 22.5, a 25% drop. Our interest coverage, 20.5 over 2, it's still 11 with a bit of rounding. 20.5 profit over 80, 26%. And if you perform the same calculations for firm B, what you're going to find is interest coverage goes up to 4.2 or down to 2.5. ROE starts at 53%, will go up to 71 or down to 34. So I think the numbers once again paint a fairly obvious picture, even if it's not absolutely as clear-cut as it was last time. The biggest one for me, as I say, is to look at interest coverage. Even when operating profit drops 25%, interest is still covered 11 times by firm A. It's down to 2.5 for firm B. In terms of the range, okay, the 34 there versus the 26 is still higher, but you still get a bigger range. The ROE generally is higher because firm B is using leverage. Yes, leverage increases your ROE. Again, something you look at in FSA, but it introduces risk. You get a bigger range of ROEs, and interest coverage is lower. That's higher risk. It is likely to increase your cost of debt. Firm A here is the company that will be able to raise cheaper debt, primarily for me because of these. And finally, in issuer-specific factors, collateral and asset type. If you have strong collateral, so assets that can generate cash that are fungible or liquid, meaning they are similar to other assets and easy to sell and realize profit for, they are going to be good to offer as collateral for debt. And if you can offer them as collateral for debt, it is going to bring down your cost of debt. Good examples, real estate, aircraft, receivables. If you have liquid receivables from customers in good credit standing, it's good collateral. If, on the other hand, you have intangibles, you have specialized equipment, difficult to realize a profit from, difficult to sell, not much of a market for them, you're going to struggle to use them as collateral. And that's it in terms of the factors that are going to affect. Just a quick example to see what stuck. Talking life cycle here, we have 3 stages of the life cycle: startup, growth, and mature. What type of debt are companies in these phases most likely to use? Well, startups, we said probably negative cash flows. You're going to struggle to get any debt. If you do manage to raise it, it's going to have to be convertible. Debt that will eventually flip to equity. In the growth phase, initially cash flows are probably still negative, but hopefully turning positive. You'll be able to use that growth in cash flows and positive cash flows to get debt. Still risky. So will probably need to be secured. Once you're mature and your risk drops and you have nice stable cash flows, nice stable positive cash flows, you should be able to get unsecured debt. And cost of capital is highest with, not very good grammar there, but revenue is stable. I would say stable revenue. High operating leverage and high interest coverage. So cost of capital is highest. Cost of capital will be highest when risk